This episode was co-produced by Startup Days, the Swiss networking and business event for startups, investors, enablers, and corporates. Check out startupdays.ch to learn more about this year's edition, taking place in Bern on May 14th, 2025. Again, that's startupdays.ch.
Fundamentally, energy underpins every aspect of the race to net zero. We can have nice conversations about all kinds of other things in climate tech, but all of them are based on energy. So fundamentally, we can't achieve net zero without changing the energy mix.
Welcome to the Swisspreneur Show, a podcast about startup stories and learnings from experienced entrepreneurs. If you enjoy listening to our show, make sure to follow the podcast and leave a rating. And now, here's your host, Sylvan.
Brynne, a very well welcome to the Swisspreneur Show. Thank you so much for taking the time to be here today.
Thank you so much for having me, Sylvan. I am looking forward to this.
You are the co-founder and managing partner of Smart Society Ventures, a decarbonization energy tech investment firm striving to accelerate net zero. A very important topic that probably more of us should take seriously and work towards. Before we talk about what you do today, I want to go back in time a little bit and start with your personal background. You originally studied history at Yale, and that's not the most common background for a VC or also an entrepreneur, I would say. So my first question is, what drove you to study history and how do you still benefit from it to this day?
That's a great first question. And I will rewind back in my brain to 2002, I think it was, when I made the decision to study history. Well, I must also say before I begin that it is much more common in the US and America. I'm American by birth, and it's much more common in the US to study a liberal arts education in college and then go into areas like finance or investing, et cetera. I was very much raised with the mentality that if you study the arts, you study humanities, you study liberal arts, you learn lessons from the past, you learn deductive reasoning, you learn ways to draw conclusions from different points of information. And as my father always used to say, anyone can learn how to be an engineer or do math or finance, but what you can't learn is how to be an interesting person at a dinner party in a professional setting. And very often the things that make us interesting people and able to build relationships are things beyond our job. They're how we think about the world, how we engage with the news, what types of history we know, what types of content we appreciate, what types of art we appreciate. And so that was kind of the foundation of wanting to study history and get that foundation from a liberal arts perspective about really, how we got to be where we are today and the history of the world.
I love that. I think that also then probably helps you still until today to make better investment decisions. If you understand the past, you can derive lessons from it to make a good setup for the future in that sense.
Absolutely.
What then motivated you to pivot into finance? You said it's more common to have that sort of educational and then career path in the US compared to Europe, but what motivated you to go into finance in the first place?
Yeah, well, it's interesting. So I went to Yale for my undergraduate education, and I graduated in 2006, so a bit ago. And at that point, the only majors that they had really that people did who went into finance were political science, history, or economics. There was no finance major. There was no kind of technical education. In fact, in the US, and I think Oxford and Cambridge have similar views, there was almost this obsession with not being quote unquote vocational, not studying what you went into. So there were a lot of people like me that studied history, political science, economics, and went into investment banking, private equity, hedge funds. In my case, I decided to go into investment banking on the corporate finance side. When I was in college, I did an internship in sales and trading, but I thought that it was a little bit specific. I thought it would be harder to go to a generalist business position from sales and trading. What I really wanted to learn was how companies work, how they're financed, what their strategy comes from. And I felt like corporate finance and investment banking, and it was a generalist role, was a great foundation for that because I got to work across industries and across companies and across different types of transactions from M&A to IPOs to just kind of general financings, equity and bond offerings. I also at Yale learned Mandarin Chinese, and please don't test me because it was a long time ago. I had the opportunity from that to start my investment banking career in Asia. And I started in Hong Kong at Lehman Brothers. And that was an incredible experience in and of itself. I did investment banking all throughout Asia, spent a lot of time in India. In fact, lived there for about a year as well through my time in banking. And then I moved to the buy side to the private equity seat. And I did private equity in Asia for a couple of years before coming to London to do my MBA.
As that wouldn't already be a very impressive career on its own, you then decided to do your MBA, but also to start your own company, Topia, a tech solution to manage employee movement and work location flexibility. What was it like to sort of learn about entrepreneurship during your MBA studies, but also in practice at the same time? I envision that to be a pretty cool combination.
Yeah, it was awesome because MBAs can be a little theoretical. And so I felt like it was really valuable to be able to do the coursework, but also be working on a real business at the same time. And the other side of it is it takes a long time to start a business, to think through it, to iterate. And, you're not making any money during that time period while you're building the business and achieving initial customer growth. So the MBA experience, I went to London Business School. It's a 2-year program. Most people do an internship in between the 2 years, but I used the entire 2 years to build the business plan for Topia. And it was exactly what was needed. A lot of my classmates from my MBA were incredibly helpful and did project work during the MBA course to help me refine the business plan. And it was a very special time period to be able to use those 2 years to practically apply the lessons from the MBA and also honestly just take that time when I wasn't working anyhow. And I had already kind of factored in that I wouldn't be earning a salary to start the company.
That sounds like a great starting point. And I wonder, where does your entrepreneurial drive ultimately come from? Did you have any role models in the family, or what got you hooked with entrepreneurship?
Well, it's kind of interesting because I didn't really grow up in a family where there was all these stories of entrepreneurs and this lore. But as I got older, I actually learned that I am from a long line of different entrepreneurs through the generations. Some of them were very successful, some of them were not. The more successful ones are the older ones that had already died before I was born. So it took me a little while to learn about them. But the most poignant example for me growing up was my mother. My mother started a retail store right after her university, and she owned and managed that store for 50 years. She became the longest independent retailer in the area in Western Massachusetts where I grew up. And, I watched her have that work ethic of running the store. I was a gymnast growing up, and my practices were an hour and a half drive each way to practice. And then I had a 4 or 5 hour practice, quite a serious gymnast for the US. And so my mom would drive me to practice. She would sit at the local library or in the car, and she would do the accounting, the books for the store by hand while I was practicing. And then I'd get home and go to bed about 10:30 or, 9, 10:30, 11, whatever day it was. And she would drive into the store and she would work all night regularly, going through boxes and setting up displays and these kinds of things. So I think I really learned that work ethic and that commitment to something that you're building from my mother. What I learned later in life is that both of my great grandfathers, so both of her grandfathers, were pretty prominent entrepreneurs in the 1900s. One of my grandfathers founded a silk glove company called Niagara Made. And we have the posters actually in our house. You can buy them on eBay. And it grew to be a pretty big business in the US, making silk gloves and stockings. And it was acquired by Van Raalte, which is a Dutch company. And then my other grandfather was an orphan, and somehow he was taken in by a foster family that helped raise him. He made his way to Duke University, and then he became an entrepreneur as well, selling fruit and then founding a cookie company called Fine Foods of Virginia, or FFV. And FFV at one point was the largest cookie company in America. And in Richmond, Virginia today, there is a real estate development called Cookie Lofts, which is his old factory. He also sold that company to a company called Interbake. I don't know if it still exists. And for him, also the tins, you can still buy the FFV tins that the cookies were in. He was the first person, I guess, in America to sell cookies in tins, which I guess at the time was quite an innovation. So I guess hopefully those anecdotes are interesting. And I guess it does indicate that entrepreneurship is a bit in my blood.
100%. And this work ethic then also made you stay at Topia for 9 years as founder and CEO. And I know we could probably do just a whole podcast episode about that journey on its own. But if you had to summarize, what was that journey like? Was it more ups than downs or more downs? How was that real almost a decade of entrepreneurship for you?
It was incredibly fulfilling and a very rich learning experience that I draw on every day to put into supporting the companies that we invest in and where I become a shareholder and or a board member. Just a tiny bit about Topia. When I lived around the world in banking, it was painful. It's hard to move. Everyone knows that. And we had a vision that we could digitize global relocation, kind of like Travelocity or Expedia or Skyscanner or one of those businesses does for the travel industry. It turns out that it's much more difficult to do it in the relocation industry. It turns out that most of the sales are enterprise sales to large companies. And so that's very, very difficult as a startup. So building Topia, I think much like we were talking before we started this podcast, I just built a house here in Geneva and moved into it. All of these things are much harder in reality than they are when you start planning it. But it was a great experience. I learned there were probably an equal number of ups and downs. I'm very proud of what we built. We grew the business from an idea literally in the library at London Business School to global scale. We raised $110 million in venture capital funding from some of the largest and most experienced investors in the world. And we grew the company 100% top line annually for multiple years. We acquired a business in Estonia that became our product and engineering hub. We acquired a business in Seattle that became our US product and engineering hub. And I think what I'm really proud of is the team and the fact that we navigated what was a really hard business through a lot of different pivots and acquisitions to ultimately bring the company to great global scale. And Topia was actually acquired a couple of weeks ago by a private equity fund. So that journey now has a nice bow on it from beginning to end. But as you can tell from the math, 2010 to 2025, it took much longer than we had ever envisioned. We made a ton of mistakes we made a lot of product mistakes. We made some mistakes about board composition. And then we did a lot of things incredibly well. I mean, we were one of the first, I think, European companies to raise large scale from a US investor. We crossed that Atlantic divide where a lot of companies fail. We got acquired. There's things I'm incredibly proud of, but I could do, as you said, a whole episode on all of the learnings and challenges that I have had. And I like to speak on that. I actually just spoke on it at the University of Geneva a few weeks ago. So maybe that's another broadcast for another time.
Absolutely. And congrats on the recent acquisition. That's a fantastic sort of end to that journey to a certain degree, right?
Yes, exactly.
You then decided to step down from your operational role already in 2019. So like 9 years into the journey. And you said it was really fulfilling for you to have this role to build the company. So I was wondering what made you step down, because that must have been a very difficult decision on a personal level.
It was. But I also had the opportunity when I was building Topia to do a lot of work politically. First in the UK, when David Cameron was the prime minister, there was a lot of dialogue with the tech CEOs and entrepreneurs at the time about building a more vibrant tech ecosystem in the UK. These days we call it Tech City, and London is a very different city than it was in 2010. There's tons of venture firms, there's tons of companies, there've been big exits. But if you rewind 15 years ago, it was still pretty nascent relative to Silicon Valley. And so a lot of us had the opportunity to engage with that administration and share feedback for how we could build the ecosystem that London has today. I moved back to Silicon Valley in 2016 to expand Topia into the US. And I already had the political engagement bug. So I then had the opportunity in the US to partner with a group of CEOs in an organization called TechNet that engages at the state and federal level in the US around similar questions, building innovation hubs, applying technology to big societal problems, and those types of things. So that was during the first Trump administration. So I had the privilege of visiting Washington a couple of times, both houses of Congress, the executive branch, and working closely with the California government at the time. And I was really excited by the opportunity for tech and entrepreneurship to do more than build one company. I felt like I'd been a CEO of one company for nearly a decade. I was really proud of what we built, but I really was excited by the learnings that I had had about building products and building companies at a global scale. And the problem that I was really excited about was how technology could facilitate economic growth and development for more people, and how technology could help solve the global climate crisis and facilitate the energy transition. And through all of that work, I had an opportunity to run for US Congress in California in 2020. And I thought long and hard about it. And there was a natural break in the company because I had just acquired two businesses and we had a lot of technical work to do to integrate the technology systems. And that is not my area of expertise. We needed a more technical leadership team that initially I was going to build, but then I thought, it's a natural time to transition CEOs. And this is not what excites me every day, integrating legacy code bases, and other people it does excite. So what the company needed at that point was someone who got excited every day about working through legacy code bases and launching a new platform. And for me, it was the right time to take my learnings to a different plane and see how they could apply to large societal questions.
I love that. It's like even on a bigger scale or on a bigger level to have a positive impact on the world in that sense. A big challenge that I often hear from companies is if then a CEO or even the founder leaves the company, even though 9 years is a very long time, what do you do with the founder shares? Because on one point, you want to make sure that the company's management team and the people still working there full-time operationally are incentivized in the right way. And at the same time, you also worked very hard and very long for your founder shares. So how did you solve that part?
Well, I think it depends if you're vested yet or not. In my case, I'd been there for 9 years. So all of the shares were vested. So they were mine. So they stayed with me. And I did stay on the board for 2 years and support that transition and continue to be involved in the company. But then after that, when I started investing, it was time for me to fully move on from the company. My co-founder, Steve Black, stayed with Topia longer than I did, a few more years, and helped to carry the cultural flame forward between the two founders after I had transitioned. And he and I stayed closely in touch. He is now actually my fellow founding partner at Smart Society Ventures, which I know we'll get to, but I have incredible trust in him, probably more so than anyone else professionally. So one of the reasons that I felt really comfortable stepping away and stepping to a new role on the board was because I knew that Steve was going to be there, continuing the culture, the vision, supporting the team with that transition. And we did hire a new CEO, but sometimes those things can be tough for organizations. And so for me, it was a lot better to also know that Steve was going to be there working closely with the new CEO and bringing the history with him.
Amazing. And now it's a very strong sign that you will continue working together on the new venture, basically. You did not succeed in the end with your candidacy for Congress. And I just wonder, do you sometimes wish that you had and that this would have been your next step instead of becoming an investor?
Well, Sylvan, I don't know how much American news you've read in the last couple of weeks, but I can say that no, I do not wish that I had. It was a blessing in disguise that I lost. I'm really glad that I did it. I was disappointed that I lost initially. It was an uphill battle from a campaign statistics perspective. Only 28% of the voters where I ran were in the party that I ran for. So we knew it was always going to be a bet on whether we could build a bipartisan coalition around innovation and really convert people from the other party on more of a pro-business mentality. I sort of underestimated that my own party maybe didn't like people to be very pro-business. So my party at the time, I now am an independent, but it was an incredible learning, and it was pretty expected in many ways that I wasn't going to win. But I also think things happen for a reason. Life generally, I think the cards often land where they're supposed to. And for me, it was better. I think it's better in the long run not to be in the public sector. But what I do uniquely bring as an investor, which informs how we build the firm and how we invest and how we think about energy markets, is I understand the intersection of politics and policy deeply with innovation, with energy, and with the broader technology space, I think in a way that I wouldn't if I hadn't run for Congress. I also have relationships across European and US governments from that. And that is very, very valuable on many, many levels. And one of the reasons that I founded Smart Society Ventures with a focus on energy technology investing is because intellectually, I am very motivated by the intersection of policy and innovation. And energy is a sector that eats and breathes and has its heartbeat around innovation, but also geopolitics. 50% of every UK recession since 1970 has been tied to fossil fuel price increases. If you look at history, almost every major war that's been fought in any part of the world in any century is tied to the race for energy in some way. And so I feel really strongly that the ability to achieve energy independence at the same time as achieving an energy transition, at the same time as meeting escalating energy demand growth from emerging markets and AI primarily, is an absolute imperative for everyone on Earth, for stable politics, for stable countries, for stable lives, for each individual person's pocketbook and safety. And that's very, very exciting for me. And it's better affected for me as an investor, given my entrepreneurial background and my political background, than it is sitting in Congress and doing antics on, C-SPAN.
Yeah, definitely. And unfortunately, so that's the intersection, probably one of, if not the biggest problem that we have to solve in these days. Society is a humanity, basically. Your venture firm is called Smart Society Ventures. And I wonder, what do you exactly mean by the term smart society? I'm just curious to better understand that.
Yeah, there's a ton of different aspects of a smart society. And we picked that name because it can embody many different pieces of it. Obviously, today we focus on the energy transition pretty specifically, but more broadly, what we believe a smart society is it's one that is enabled by technology and data to achieve better outcomes, do more with less. In our case, we focus on doing more with less energy, but there's many other uses of that technological and data foundation across society. So I hope that's where we're all going, is a smarter society, more enabled by technology and data.
Absolutely. And you are a true global citizen, with being American, having your career in Asia, studied in the UK. Now you're in Geneva, in Switzerland. And I wonder, why is Switzerland or Geneva specifically the right home base for you personally, but also for your business these days?
For many, many reasons. So, like you said, I've had the opportunity to live and work across Asia, the UK, and the US. And Steve, my partner at Smart Society, is based in London. We have a lot of connectivity across the US, and one of our founders there, and a lot of advisors in the US. So, we wanted to have a base of the firm in Europe. We love Switzerland because geographically it's at the center of Europe. I would like to argue that geographically it's at the center of the world. You can fly easily to the Middle East, easily to Asia, easily to the US. You can take a train from Geneva, to Paris, to Milan, easily to Zurich. So it is a real nice logistic hub. Obviously, it's also a cultural melting pot and a multilateral melting pot. It's a bit of a tongue twister. And that is all very core to the DNA of our firm. And I think that the other piece is that Switzerland is a real leader in the broader Lausanne Geneva ecosystem today on innovations related to sustainability and research related to energy and sustainability. This is not just Geneva, obviously ETH and Zurich as well, but we kind of think about Switzerland as a single corridor between Zurich, Bern, Lausanne, and Geneva. And so I think the time is now for Switzerland, and we're really excited to be building the firm from here, as well as with our locations in New York and London.
Sounds like the perfect setup for you these days. And with Smart Society Ventures, you are a growth investor. So I wonder, through which criteria do you measure growth? What are sort of the 2 or 3 main things that you look at to measure whether a case is interesting for you?
So the main thing we look for is commercial traction. That can look a little bit different depending on the business model of the company. And just for context, we invest about 50% pure software and AI businesses and about 50% more hardware or scalable infrastructure oriented. And when we say hardware, we look for scalable hardware with network effects. So often there's a data component to that hardware. We're not doing sort of 7% IRR wind farms, but we are doing hardware that is replicable and can create network effects once deployed. And so the definition of commercial traction or growth varies a little bit between those two business models. If it's a pure software business, we're generally looking for a recurring revenue business model with a high gross margin, 80% plus. And in that case, we're looking for a particular ARR level, normally between 5 and 10. And the clarity that if we invest X, Y happens, and the business is really ready to scale revenue. For some of the heavier type hardware businesses, often commercial traction can look like a large backlog, or it can be a first of its kind or multiple of those contracts that haven't yet turned into recognized revenue, because it depends a little bit on that commercial curve. But fundamentally, we want real commercial traction that we can underwrite, that we can reference with those customers, and that we can use as sort of a framework to get comfortable that this business is at an inflection point of scaling. And the second piece is we want the technology risk largely removed. So we are not a firm full of scientists or deep tech engineers or PhD physicists or these kinds of things that a lot of the earlier stage firms that we really admire and work with have. We are a firm of people that know how to finance businesses, scale businesses, help them internationalize, help them think about strategies, new products, increasing valuation multiples, straddling the US, UK, and Europe, and thinking about Asia as well. And so we think there's people better than us at validating early technology and early scientific innovation. So we want that to be done by the earlier investors, validated by customers. And then we want to know that when we come in, this business is really ready to scale. And in many cases, that means internationalizing from its home market as well.
That makes a lot of sense. So the validation happens early. That's why you focus on the growth stage, basically. How big is your average ticket size or your range of tickets that you invest in these companies at growth stage?
It varies. Our largest investment today is about $20 million. Our smallest is about one from the fund. We are in the process of raising another fund right now. And so that will vary a little bit depending on the portfolio model of that fund. But that's the range that we've done historically.
Where do your own investors, your LPs, come from? Are they also like you, a global citizen, or do you have a specific geographic focus?
No, we don't have a specific geographic focus. I would say in general, we find two different profiles of LPs with respect to geography. There's those that are in a particular market and they really want to invest in funds that invest in that market. So for example, an LP in Switzerland who really wants to help the Swiss ecosystem, wants to invest in funds in Switzerland. That's one profile. Then there's the profile of people sitting in some completely other part of the world that want exposure to US and European innovation, since we invest across US, UK, and European markets. And those people are anywhere. They can be in Egypt, they can be in Nigeria, they can be in Panama, they can be in China. And so theoretically, a lot of people are very excited about the US and European innovation. Now, for us, because we specifically focus on energy technologies, we also find that there's clusters of people around the world that really think about energy markets all day long, like we do. Obviously, a lot of the Middle East, there's a huge focus on the energy transition. In places like Texas, Oklahoma, in the US, there's a huge focus on energy, both traditional as well as new ways of generating energy, storing it, investing into grids, and investing in new processes to do more with less. So those are obvious places for us, for LPs as well. But really, and as we talked about earlier, energy runs the world and there's great innovation everywhere. So LPs come from everywhere also.
Together with Talent Cake, Swisspreneur just released its 5th masterclass. This time on how to create the ideal team framework with your co-founders to ensure future success. It's based on Talent Cake's founders agreement. We've got Talent Cake's CEO Viviana Groppengiese, Yokoi co-founder Melanie Gabriel, and Scandit co-founder Christoph Roduner giving you their first-hand experience on how to align the goals of everyone in your team, how to split roles and responsibilities, and why equity, vesting, and investment are topics you need to discuss from day one. It's an intense team-forming bootcamp, and it's available for free on our website. Click the link in the show notes to start watching it now. So we see more and more investments happening into the energy transition, but also to support the growing energy demand. And what we see then is if there's solar installed, when we have sun, we have almost too much energy, right? And when there's wind, the same. But then sometimes when it's a rainy day or a very cold wind, we have too little energy. So I was recently at the conference at ETH in Zurich, and there we had two conflicting viewpoints. One said, energy is so strategically important, especially if you think about all the AI applications, etc. So you need to really heavily invest as a country to have energy sovereignty to a certain degree. And on the other hand, there was one guy saying, oh, we are actually up here in Norway. We get a lot of free energy from Germany all the time because they produce too much. They need to get it out of the grid. So we actually have free energy up north sponsored by Germany. That sounds like a very crazy world. Which way are we headed to? Do you think that energy will eventually become free? Or do you think it will still be maybe short term and then long term it will get free? Short term, a strategic advantage from a country or region perspective to have energy security compared to others that don't have that and then depend on you?
Well, there's a lot of different questions in there, so I'll try to answer them and share some of my perspectives. You started by talking about storage. So I think the amount of energy that we need to meet the 18% demand growth by 2050 is going to be a puzzle of different energy generation types. Unequivocally, we need to increase the amount of energy that we're producing to meet 18% demand growth. Just mathematically, we have to grow it by 18%. We have a good amount of energy today, but obviously it's going to continue, the demand growth is going to continue to grow. The scale of that demand growth is very, very, very likely, and my personal view is definitely going to be a puzzle of different energy sources. Fossil fuels will remain a material piece of that puzzle. There is just no other way to do it because nuclear is not going to get there fast enough, even though I would like to tell you that it is. And I'm a proponent of it. We're looking at a few opportunities in that space. But there will be fossil fuels. There will be wind. There will be solar. There will be hydro. There will be biomass. There will be all kinds of different things. And that mix significantly complicates how you distribute, manage, and store energy, because fundamentally we're moving from a single generation type that is produced in a large central way and sent outward to a lot of different distributed points of energy generation across different methods that have to connect back to a grid and then have to be balanced and logically flow to where a consumer is. Our grids are not smart, to use smart society, are not smart today. They were mostly built in, the 70s, and the equipment is old. A lot of it's not data enabled. They are not flexible. And that is one huge problem in energy markets. We're very, very interested in the grid technology space for this reason, because even if we were generating enough energy, which we largely are today, there is the problem of how you get it in places and then how you have consistent costs in that world. To the Norwegian gentleman's point, sometimes it's free. Sometimes the prices spike, like everyone listening has probably felt at some point. Some of that is the grid technology issue. Now, the other piece of this is the storage issue. Obviously, in that multi-generation asset map, there's a lot of energy generation assets that are dependent on weather, and the weather changes, whether it's sun or it's wind or it's something else that is intermittent. And so what you have to do at the same time as modernizing the technology and the data for the grid, which AI can play a big role of, you have to harden that grid. And what that means to harden a grid is to put storage, integrate storage, in most cases battery storage, with the grid so that you can mitigate that intermittency from the generation on the weather side.
I love that perspective. I just learned so much new things about what we need to tackle. Where do you see these technologies today? Talking about smart grid and also storage, I feel there, as you said, most of the technology is outdated, but you also see a lot of technology coming out there, startups coming out there. Are we on the right path, or do we really need to hurry and double down to fix these issues even faster than what you see today?
Well, there's a lot of exciting innovation happening. And as you said, Sylvan, there's a lot of startups. So I think, yes, we are on the right path, but we need to do it at a much larger scale. We need to scale a lot of these technologies also themselves, and we need a lot of money behind funds and those innovations to make that happen. Now, if you look at the market, the initial big spike in investment was in energy generation, like sort of the first generation of talking about the energy transition over the last 20 years. A lot of that went to the buildup of solar, of wind, of other renewable technologies. It's pretty recent that we've all started talking about storage and grid even more recently than storage. And so those segments of the market somewhat lag behind the generation segment of the market in terms of storage capacity, storage flexibility, that to match that renewable energy generation and that complexity of asset map puzzle, I call it. I hope that didn't sound too much like some consultant, but these are complex things. And then the grid tech space is even more recent. It's a lot of companies in the series seed A, B stage. I don't think that any of us can probably point to a grid tech company that's been a huge IPO, right? Like, it's still a relatively young segment. And so as an investor, I get really excited about, there's parts of generation that I'm excited about. Like, I'm excited about using AI and software to optimize generation assets. I'm excited about some of the new nuclear technologies, particularly on the SMR side, where they can be more scalable and cost effective. I'm always looking for new solar or wind technologies that are scalable. Volteris, based in Lausanne, is a great example of a solar innovation that is unique, that is patented, that is applied to decarbonizing the global greenhouse sector. I made a small angel investment in that business recently. But I think there's also huge, huge opportunity that I'm really excited about in storage and grid, and arguably more of it than on the generation side.
Fantastic. And I also want to briefly talk about the founders that you work with. On your website, you say you look for founders who are globally minded, ambitious, visionary, hustling, and self-aware. And I wonder, it's always difficult. How do you sense these qualities in people when you're evaluating a deal? Do you need personal face time, or how do you do that? Because that's a bit like recruiting. It's the billion-dollar question. How do you find the right people?
I mean, it is the hardest part of the job fully. I think founders make or break companies, even when they get to the Series B or Series C stage. It's a really, really, really hard journey to build a company. I think that it's inexplicably difficult to articulate the ups and downs and how difficult it is if you haven't done it yourself. And it's one of the reasons that I feel so strongly that we need more investors that have built companies themselves, because it can be very lonely. It can be very hard to make a decision when everyone's telling you different things. It is even difficult with the team, because the team goes through that too. They go through those ups and downs. They feel it. They make huge sacrifices. But at the end of the day, it's the founder or the CEO that's responsible for the cash, responsible for keeping the company afloat, responsible for seeing all of the dots across the market and pulling them together and getting everyone else behind it. And that is very, very, very difficult. And so it's an art to assess those qualities. It comes with experience. I think it also comes with having been one yourself. So you know kind of what to look for. You know where naiveness can come in. You know what type of grit is needed, so you can assess that grit a little bit more. But we make mistakes, just like every investor does, even people that have been investors for 50, 60, 70 years. If they don't tell you they make mistakes on people, they're lying. Everyone does. People are hard. Slides are easy. That's one of my favorite sayings. And that's why I feel so strongly that one of the key things that we bring is having built a company ourselves, to our founders and to our investors. And then I guess if I distilled it down really specifically to what I think is the marginal thing, it's self-awareness. People can learn a lot, but you have to be open to learning, and you have to be open, being coached, having radically candid feedback, to changing, to going through hard times, to going through great times. And the people that I've seen really fail, regardless of how skilled they were, how great the innovation was, or what their CV said, are the people that thought that maybe they knew everything and brought ego to the table, because ego makes or breaks leadership and companies.
Fully agree. Yeah, very well said. Now, the last question in that section is, you do something really good for the planet, for society, but at the end, you're also an investor, right? You need to generate a return. So how do you balance these two? Is it clear it has to do good, but also be good for the balance sheet in the end? Or how do you balance these two? Sometimes I could imagine even conflicting interests of doing good for the planet and for society and doing good for the fund.
So we are not an impact investor, and we do not have impact in metrics tied to our returns or really roped into our investment assessment. There are a lot of great funds that do that. We are an energy technology firm, and we seek to deliver best in class returns. So we quite simply look for the best entrepreneurs with the best innovations, with the best traction for the stage that we invest, that we can throw the weight of our time and our firm behind to help scale. And because of what we invest in, which is the energy transition, it fundamentally is critical for society. And we've talked about all of these points today. It is fundamental. It is critical to achieve energy security and energy independence, because the alternative has driven global wars for the last 400 years, right? There's no bigger impact than that, whether we have impact metrics or not. Fundamentally, energy underpins every aspect of the race to net zero. We can have nice conversations about all kinds of other things in climate tech, but all of them are based on energy in some way. So fundamentally, we can't achieve net zero without changing the energy mix. There are 1 million people a month in emerging markets entering the middle class, and they need more energy, right? And fundamentally, as people enter the middle class and they achieve a higher per capita income and consume more energy, like that is good for them. That is good for a country to have less poverty and have more people entering the middle class, and they need energy to do that. So the positive impact on the world underpins everything that we do, but we are an investor first and foremost. We exist to generate a target IRR for our investors. And in order to do that, we invest in the best entrepreneurs and the best companies that we can find across the US and Europe and the UK.
Fully understood. Now, we are living in a very strange time, I feel, these days. Every day there's like a different news popping up. And I wonder, just to get your perspective on the future outlook, where are we headed? Just a bit of a future outlook. How do you see the near, but also the longer term future?
Well, I'm an optimist, because I don't think you can invest in early stage companies in private markets unless you're an optimist, because your whole job is to make bets on the future. So what I'm really, really excited about, and why I do this job every day, is I'm really excited about the opportunity to use technology in different ways to build a better future. And from what I think about every day, which is energy markets, the opportunity to build a better future through technology is generating more energy so we can reap the benefits of AI. We can support middle class development across all parts of the world. And it's achieving energy independence so that maybe we can mitigate and lessen some of the geopolitical conflicts. It's lowering energy prices, because I think high energy prices, as we've seen in multiple elections from the US to the UK to Germany most recently, high energy prices are a huge part of polarization, and they're a huge part of extreme politics and people weaponizing those. So I'm optimistic that if we can use technology to change the price curve and make energy more independent, that maybe we can bring our politics back to a place of pragmatism and centrism. And then finally, I'm excited about using technology to achieve net zero. And I think we will get there if we can take the best of technology and apply it to the most poignant parts of the net zero shift. There are other things that play a big, big role in this. In my other job, I co-host a podcast like you, Sylvan, called The Smart Society Show, where we talk monthly about climate and energy, politics, markets, and innovation. And we take a bit of a broader view than we do from our investments. So there are many other great innovations, and there's great political and corporate leaders driving sustainability and the net zero agenda. So this is not just, investment into energy, but it's everything. And so that's where I think we're going. Like I said, I'm an optimist, but I think it's all based on technology and innovation.
Absolutely. Yeah, you have top-notch guests on your podcast, like the former MP and UK Energy Minister, for example, and many, many more. So highly recommend that one. So to wrap up the conversation today, I have 5 really short rapid-fire questions. I give you a choice and you have to answer in maximum 1 sentence. Founder or investor?
Investor.
History or finance?
These days, finance.
Nuclear power, solar power, or traditional fossil fuels?
All of the above, as we've talked about.
The mix of it. Do you regret making an investment or regret not making it as an investor?
Depends on the founder.
Fair enough. And the last one for you, it's a bit of a mean one. The United States or Switzerland?
Well, this is a bit like picking your favorite child or your favorite investment. So I'm going to answer it the same way that we have our investment strategy. We look for the best of both, the best of Europe, UK, and the US. That's who we invest in. And I look for the best of life in all of those as well.
Wonderful. Brynne, that was very insightful. Thank you so much for your time and for coming on the show today. I wish you all the best for the future and keep doing what you're doing. It's really inspirational for all of us.
Thanks so much, Sylvan. I appreciate the invitation. Have a great afternoon.
We hope you enjoyed today's episode. If you did, you can support us by rating our show on Apple Podcasts. This way, we can reach an ever-growing number of aspiring entrepreneurs.